During 2008, as home prices dropped, the Conference Board's Consumer Confidence Index plunged from about 100 to just around 20. And as confidence drops, consumers often pull back on spending. That spending slowdown can quickly ripple through the broader economy, turning a housing slump into a full-blown recession. But again, today, things look different. Mortgage rates are sitting at their highest levels in decades, and home sales have been falling for more than 3 years, yet we haven't seen a meaningful correction in home prices. There are several factors that could explain why. One major reason is in something called homeowner equity. Put simply, homeowner equity is basically how much of your home you actually own. It's the total value of the property minus the outstanding mortgage debt. And today, American households are sitting on around $35 trillion in home equity, more than doubled from what we had before the 2008 crash. That means homeowners are far less dependent on debt and have a much larger financial cushion. So even if prices dip, most homeowners aren't forced to sell. And even those with mortgages are holding up well. This chart shows the share of mortgage loans that are behind on their payments. And today, it's near record lows. That's a very different picture from the years leading up to the 2008 housing crash, when delinquencies were already rising and many homeowners were forced to sell into a failing market. Today, most homeowners are in a much stronger position, sitting on record equity and manageable payments, which is why we haven't yet seen a meaningful correction in home prices, at least not yet. Home sales dropped simply because the housing market froze. Sellers don't want to sell at lower prices because they don't need to, and buyers can't afford to buy at current prices because mortgage rates are still high. But this doesn't mean home prices can stay elevated forever. If home sales continue to slide from here, the standoff between buyers and sellers might eventually break. At some point, sellers could step in to meet the market, accepting lower prices to clear deals. That would likely trigger a decline in home values and dent consumer confidence. And as we've seen in both 2008 and the early 1980s, that chain reaction can quickly spill over into the broader economy, potentially pushing it into recession. The other possibility is if home sales are actually finding their bottom here and begin recovering. If that happens, it could stabilize home prices or even push them higher. That would help preserve household wealth and keep consumer confidence intact, potentially allowing the economy to avoid or at least delay a downturn.